Morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We're also going to take a look at the emerging markets. We're going to take a look at the summation indexes, and we're also going to take a look at some sentiment readings in today's video. As always, if you like this content, please subscribe to our channel so you can see this on a weekly basis. Let's jump right into it here. Now, the S&P 500 has had a strong week, so of all of the indexes, as we have pushed over that 200-day moving average and continued to grind higher. Strong action so far this week, but you'll notice where we're at. We're at that next resistance point on the S&P 500. That's that 31.20 to 40 zone, and that comes from the bounce high back in March. It also comes from where we ultimately made the breakout there at last December before we made that ultimate push here up towards those all-time highs. So really good action so far out of the S&P 500. But once again, here we are at a resistance zone. And if you want to talk about a resistance zone and an index has done extremely well, we have to go and take a look at the Nasdaq. The Nasdaq did make a new all-time high today, the Nasdaq 100. We have that push right here, right now as we're speaking. However, all this does is basically line up pretty much exactly with where we were at in February, right? It's a couple of ticks higher. So we have that big V. The question, of course, now is, does this continue on to the upside, or does this ultimately play out like a double top, which is what I see a lot of people thinking might ultimately happen. We're going to take a look at the summation index data here today in this video, and it's actually pretty positive. So this may continue to follow through to the upside, but of course, it's resistance until it's not. So we're going to have to watch how this reacts here over the next couple of sessions. But so far, NASDAQ, super strong. We take a look at the Dow Jones here. What we've got is we've got a major resistance right here at this 200-day moving average. That's where we're at. I'm pushing into the underside of that 200-day moving average. And the Dow, as we've talked about a number of times, is still much weaker than the other indexes, as it hasn't even gotten back to that resistance zone from last year. That's up there around that 27,500 level. That's really where we need to get back up to. So, you know, the S&P 500 is essentially the equivalent to being right here up at the March bounce highs. And here we are in the Dow, a little ways underneath of it. And of course, when you want to talk about lagging, we have to take a look at the Russell, which has been the absolute worst performer now for years. And what you'll notice here when we take a look at the Russell is that we are in this major resistance zone of 1450. We've talked about this for a while because this was all of the support zones from 2019 and the beginning of this year before we ultimately had that breakdown. So big resistance point right here. If we get up above that, the next really important level is going to be about that 1600. And you can see how many times we've tested that here over the last few years. This chart, 3 years, and you can see the importance of this level going all the way back a number of times. So if we make this break over 1450, watch that 200-day moving average. A push up would give you that target back up there around those 1600s. That's what we're certainly watching for. Again, extremely weak. Underneath the 200-day moving average, hasn't even tested it yet. Or at least the Dow is testing it at the moment. Now, the emerging markets also have had their fair share of issues here over the last few years. We've talked about this 940 zone as being super important, and here we are. We broke above that this week, and this move is this week. That is a huge push higher out of the emerging markets. It's one of the best weeks they've had in a very long time. However, we've got the 200-day moving average and that gap down resistance zone from March right at that big round 1,000 level. If we get back up above that, I would be looking at that 1,100, and you can once again see all of the times that subsequently was important going back over the last few years. So what happens right here, very important. So the thing you can take away from everything that we've just looked at is all of the indexes are at an area of major potential resistance, right? NASDAQ, right at that potential double top all-time high. The S&P 500, right at that level we made that breakout from last December. The Dow 200-day moving average. The Russell is right at that 1450 key level, just under that 200-day moving average. And here we are with the emerging markets right in at that around 1,000 level. So what happens here, really, really important. Now, let's take a look at some data sets. The first thing I want to take a look at here is that smart money, dumb money confidence indicator. We have our crossover. We've been talking about that for a while. Dumb money continues to push higher. Smart money continues to push lower, right? We're still not stretched. So it's not something that I'm concerned with at the moment, but it's worth paying attention to. As I've said, we will cross over eventually. We can do it every single time, essentially. This will continue to drop. This may continue to rise. As we start getting towards that 80 and that 30 level, when we get there, that's when I start really looking at sentiment kind of reaching those extremes. It's starting to be a bit of caution here as the retail traders are a lot more confident than the institutional investors are at the moment. And we notice, as time goes on, the further this gets stretched, the more likely we are to ultimately have some sort of a pullback. Now, the rest of the data sets we're going to look at are actually really bullish. So let's jump into them. We've talked a lot about the Nasdaq McClellan Summation Index over the years. It's a breadth reading. It's really important to see if we have broad base rallying and support from the overall market. What we've gone from here is we've gone from under 1,000 to over 500 now. And every other time in the last 20 years or so that has happened, we have seen some very positive action out of the market. The last time that did happen was 2019, as we came out of that 2018 kind of bottom, and we pushed up for quite some time before ultimately running in trouble this year. We saw it again in 2009 as we were getting out of here. And we saw, of course, push for a very long time out of that. You go from not a whole lot of broad support to very broad support. It is subsequently a good thing for the overall markets. Let's look at the actual numbers. Every time this is played out here since 1962, if we look at that data set a year later, the market's positive 76% of the time. 6 months later, 86% of the time. The worst reading was 1 week later, 2 months, and 3 months later, and we were still positive 2/3 of the time. So overall, a very strong data set. But this gets even more interesting if we look at how quickly the move from that negative 1,000 to plus 500 plays out. When we have this cycle from low to high in less than 40 days, we're positive after the first week 100% of the time going out to a year. Now, there is 1, 2, 3, 4, 5, 6, 7 previous data sets, and then, of course, this one makes 8. So it's not huge. You'll notice it was 70, 72, 75, 80, 1988, 2009, 2019, and 2020. And you look at this chart, they're all coming out, for the most part, from some potential V-shaped type bottoms where things really got stretched too far in one direction, and ultimately we continue to push higher. This is one of the better looking data sets that we've seen for future price action as of late. And this even still goes when we look at it in the emerging markets from their summation. Now, they didn't cycle all the way from negative 1,000 to plus 500. They cycled from negative 1,000 to 0 and got above that 0 line. The other time that happened in the last 20 years was near that 2009 bottom before proceeding higher here. So this is good. Again, seeing broad-based support not just in the U.S., but also abroad. This is, again, one of the better data sets that we've taken a look at in quite some time. However, we still have lots of concerns in terms of valuations. In fact, the mid and small caps are now trading at the highest forward PE ratio that they've ever traded at in history by a long shot. So there are still reasons to be concerned about this market. But what we are seeing is we are seeing broad-based support across almost all of the asset classes. And that typically has preceded some very strong returns moving forward. The question, of course, now, and we've been asking for a while is, do PE ratios even matter anymore, in the sense that we have put so much money from the central banks into the market that our average PE ratio might now, instead of being in those mid-20 zone, may now be 30, 40, 50. Only time will tell us. So we have to take a look not just at valuations, but again, technicals, and also take a look and see whether we're having that broad-based support, which we certainly are having here. As always, if you guys want to reach out and ask me any questions in regards to the markets, feel free to reach out at Tedeschi@perspectivewealthplanning.com, or you can reach me at 814-580-9881. I hope you guys have yourselves a fantastic week, and I'll see you next week. Take care.